As many of you guys know, dividend ETFs are a popular investment option for income investors as they offer a diversified portfolio of dividend-paying stocks. In this video, we're going to be discussing the top 5 dividend ETFs that can help you achieve a consistent income stream and long-term growth.
Insolvent? You only have enough cash for the next 3 customers!
So, what are dividend ETFs? Dividend ETFs, or exchange-traded funds, are investment vehicles that focus on stocks of companies that pay regular dividends. These funds offer a diversified portfolio of dividend-paying stocks, which can provide a steady income stream for investors. And with that in mind, guys, the benefits of investing in dividend ETFs are clear and concise. By investing in a dividend ETF, you gain exposure to a wide range of dividend-paying stocks across various sectors and industries, which can help reduce your risk and bolster your dividend income ultimately. Looking at the fact of lower risk dividend-paying stocks are more often than not associated with more stable and mature companies, which can help reduce the overall risk of your investment portfolio and generate more income at a lower risk. With this in mind, guys, dividend ETFs provide a consistent income stream through regular dividend payments, which can then be reinvested to compound returns or used to meet current financial needs. The overall capital appreciation of dividend ETFs is very appealing as underlying stocks increase in value over time, which in turn guarantees a return. All other benefits aside, dividend ETFs offer low-cost, passively managed funds. These dividend ETFs typically have lower expense ratios than actively managed mutual funds, resulting in greater cost savings for investors. Now that you have an idea of dividend ETFs, we're going to start off with number 1. VIG, or better known as the Vanguard Dividend Appreciation ETF. VIG is one of the top dividend ETFs for income investors as it tracks the performance of the NASDAQ US Dividend Achievers Select Index, which includes companies with a history of increasing their dividends for at least 10 consecutive years. With this in mind, VIG focuses on high-quality companies with a strong history of dividend growth. The fund aims to provide investors with a consistent income stream and potential for capital appreciation, as well as its low expense ratio of 0.06%, making it cost-effective for investors and making it one of the lowest expense ratios for ETFs in the dividend space. Currently, VIG's top holdings include the Microsoft Corporation, Procter & Gamble, Johnson & Johnson, the Coca-Cola Company, and finally the Home Depot, all of which provide a strong stream of income and as well have a strong history of dividend growth. And with a 10-year average annual return of 11.25%, the fund has consistently outperformed its benchmark, the NASDAQ US Dividend Achievers Select Index, and has provided investors with a steady stream of income through dividend payments. The dividend yield for VIG has historically been competitive with the dividend ETF space. As of March 12, 2024, the fund's 12-month trailing dividend yield stands at 1.80%. This yield is calculated by dividing the total amount of dividends paid over the past 12 months by the current share price. Overall, VIG is an excellent choice for income investors seeking a diversified portfolio of high-quality dividend-paying stocks with a low expense ratio and focus on companies with a history of dividend growth. VIG is well positioned to generate a consistent income stream for investors, which makes it the top dividend ETF.
With desperate publicity stunts.
Coming in at number 2, one of my personal favorites, the SCHD US Dividend Liquidity ETF, SCHD. SCHD has a strong investment strategy. It tracks the performance of the Dow Jones US Dividend 100 Index, which is comprised of high dividend yielding US companies with a record of consistent dividend payments. The fund focuses on long-term growth and capital appreciation while providing a steady income stream through dividend payments. SCHD has a low expense ratio of 0.06%, making it cost-effective for investors and officially tying it with VIG. A few of SCHD's top holdings include Broadcom, AbbVie, Merck & Co., Texas Instruments, and Verizon Communications, all of which have a high dividend-paying yield and strong growth. And when we look at the historical performance over the past 10 years, SCHD has delivered an average annual return of 11.25%, outperforming the broader market, and the fund has consistently provided a steady income stream through dividend payments with a 10-year average annual dividend yield of 2.9%. And its current dividend yield as of March 12, 2024 is a 12-month trailing dividend yield of 2.8%, which is competitive with the dividend ETF space as of now. What we can infer is SCHD is a strong buy and is on track to be a huge player in the dividend ETF world. Its low risk, high dividend payouts, and its holdings is what makes SCHD SCHD. A favorite among many, this ETF is a rising star in the space. A recession or not, this ETF has stood strong and continues to stand strong.
Yeah, you better win your fight because I'm coming on your ass, boy. I'm coming for that ass. Pause.
And coming in at number 3, guys, we have HDV, or the iShares High Dividend ETF. HDV tracks the performance of the Morningstar Dividend Yield Focus Index, which is comprised of relatively high dividend-paying U.S. equities with a focus on value characteristics. The fund aims to provide investors with a steady income stream through dividend payments and potential for capital appreciation. And its low expense ratio of 0.08% makes it cost-effective for investors, but not as low as other funds like VIG or SCHD. And I won't be going over the holdings as it's very similar to SCHD and VIG. The only difference is it's a higher expense ratio. But over the past 10 years, HDV has delivered an average annual return of 9.61%, outperforming the broader market, and the fund has consistently provided a steady income stream through dividend payments with a 10-year average annual dividend yield of 3.43%. And currently, HDV has a 12-month trailing dividend yield of 3.43%, which is competitive with the dividend ETF space once again, and is one of the top dividend ETFs that is a buy. That's why it's at number 3. What we can gather from HDV is that it's shown strong performance over the past 10 years with an average annual return of 9.61%. The fund has consistently provided a steady income stream through dividend payments with a 10-year average annual dividend yield of 3.43%. The only problem with HDV is a sort of high expense ratio, otherwise the returns and income are there for sure.
Money, 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 money.
And last but not least, at number 4, we have the SPDR S&P Dividend Yield ETF, SDY. SDY has a strong investment strategy. It tracks the performance of the S&P High Yield Dividend Aristocrats Index, which is comprised of companies that have consistently increased their dividends for at least 20 consecutive years. The fund aims to provide investors with a steady income stream through dividend payments and potential for capital appreciation. SDY has a low expense ratio of 0.35%, making it sort of cost-effective for investors. This expense ratio is significantly higher than the other ETFs, making it less attractive but different as the holdings are vastly different. SDY's top holdings are 3M, Realty Income Corporation, Edison International, International Business Machines or IBM, and then the Chevron Corp. These few holdings provide a picture of high dividend yielding stocks with strong consistent growth over the past 20 years. And when we look at the historical performance of SDY over the past 10 years, it's delivered an average annual return of 9.42%, outperforming the broader market, and the fund has consistently provided a steady income stream through dividend payments with a 10-year average annual dividend yield of 2.17%. As of present, we have a 12-month trailing dividend yield of 2.17%, which is as well competitive with the dividend ETF space, but not as competitive as the expense ratio is kind of high on this. The SPDR S&P Dividend ETF or SDY has shown strong performance over the past 10 years. The fund has a higher expense ratio and its holdings are concentrated in some areas, preventing some growth, but SDY has consistently provided a steady income stream through dividend payments, although and continues to do so.
Oh, my rights. You can't hold me if you ain't got no evidence, cop.
And finally, coming in at number 5, the Wisdom Tree U.S. Quality Dividend Growth Fund, or DGRW. DGRW tracks the performance of the Wisdom Tree U.S. Quality Dividend Growth Index, which is comprised of dividend-paying companies with growth characteristics. The fund focuses on long-term growth and capital appreciation while providing a steady income stream through dividend payments. DGRW has a low expense ratio of 0.28%, making it cost-effective for investors and less costly than SDY. DGRW's top holdings include Apple, Nvidia, Coca-Cola, Pepsi, and Microsoft, all of which provide dividend income and strong growth in the long run. And when we look at the historical performance over the past 10 years, DGRW has delivered an average annual return of 13.65%. The fund has consistently provided a steady income stream through dividend payments with a 10-year average annual dividend yield of 1.76%. The current dividend yield as of now is 1.76% and continues to be so. Overall, the Wisdom Tree U.S. Quality Dividend Growth Fund DGRW offers a lower expense ratio compared to some other dividend ETFs, which can be attractive to cost-conscious investors. However, its low dividend yield may be a drawback for investors seeking higher income from their investments. Additionally, DGRW's holdings include several hot stocks in the current market, such as Microsoft, Apple, and Nvidia. These companies have demonstrated strong growth potential and could contribute to the fund's performance going forward. While DGRW may not be the best choice for investors looking for high dividend income, its lower expense ratio, strong historical performance, and exposure to high growth companies make an attractive option for those seeking capital appreciation and a steady income stream. And now that we've discussed the top 5 dividend ETFs, we need to incorporate these dividend ETFs into your overall investment strategy. Consider the following. Determining your investment goals. Are you looking for income, capital appreciation, or a combination of both? Your investment goals will help you determine the appropriate allocation of dividend ETFs in your portfolio. Assess your risk tolerance. Dividend ETFs can offer a relatively stable income stream, but they are still subject to market risk. Ensure that your allocation of dividend ETFs aligns with your risk tolerance and overall investment strategy. And finally, rebalance your portfolio. Periodically review your portfolio and make adjustments to maintain your desired allocation of dividend ETFs. This can help you stay on track to achieve your investment goals. In this video, we've explored the top 5 dividend ETFs for income investors in 2024, taking into account factors such as historical performance, dividend yield, and expense ratios. The best dividend ETFs for income investors are as simple. Coming in at number 1, VIG, number 2, SCHD, number 3, HDV, number 4, SDY, and number 5, DGRW. I highly encourage you guys to research and try and choose the best dividend ETF for your specific investment goals and risk tolerance. But I just want to thank you guys for watching, and I invite you to like, comment, and subscribe if you want. I'm going to be posting more investment related content and dividend related content soon. Got some things coming up and I got better equipment coming up, so I'm very excited for the future. But thank you guys so much for watching, and I appreciate you guys so much. Thank you guys. Bye.